Hello, everyone, and welcome back to the Weekly Rebalance. This is our 23rd episode. Got some exciting research we're going to look at today, going a little bit of a different route and taking a look at buffered products. But before we do that, we'll do our general market update like we usually do. And yeah, let's get into it. Ethan, how you doing?
Thanks, Nick. Doing pretty well. Can't complain.
Good to hear.
Short week this week with President's Day.
I know, I know. You do anything fun?
I did not. No, it's just it's a nice to have a little bit of a slower day with the market being closed, but ended up doing a little work myself anyways. It was a good day to catch up on some emails and and stuff like that.
Yeah, exactly. I think that was a lot of people's experience.
Yeah.
Good opportunity to catch up. Well, perfect. Speaking of catching up, let's see what our markets did last week. Um, Seeing a bit of weakness in the markets here, and really part of what we're going to talk about with our buffered products or not our buffered products, but just buffered products in general and how advisors we work with use them. Just we've seen some weakness in the markets this year, and it's made some of these products that less conventional products a little bit more attractive. Particularly last week, just saw things pretty much flat. S&P almost flat last week. NASDAQ was down a little bit. The Dow posted a small gain on the week, but nothing too notable. Really, I think the biggest winner last week, similar to what we've seen earlier this year, is the Dividend Aristocrats Index continuing to just perform very, very well. Those value companies being rewarded well. Some of these more concentrated tech names, as we've noted, they have these extended multiples. They're getting a little bit expensive. We've seen some weakness earlier this year, and we haven't quite seen a rebound just yet at this point. So some weakness in those names. Um, in particular, I think one of the interesting things from last week was some of the names that performed particularly well, not ones that I usually expect. We've got Pepsi and Hershey's up at the top of the list as really good performers for last week. So consumer staples holding up well. Although I guess Pepsi, I guess could be Pepsi and Hershey, I guess could be on the line between staples and discretionary, but nonetheless, those more common household names holding up very well.
Yeah, absolutely. And it's just been a volatile year thus far. Lots of different assets that have been, the stalwarts of the last couple of years have really been volatile. So, it really ties into, like you alluded to already, Nick, some of the research that we were going to present this week and just some coverage on buffered ETFs. But a lot of people are, looking for some alternatives to, their asset allocation, especially during periods of time that are a little bit more volatile than they have been, at least in the traditional assets that a lot of people are heavily weighted in at the moment, like your big tech names, the major players in the S&P 500, major players in the NASDAQ, which have been a little bit more volatile this year.
Yeah, absolutely. So, and here I've got a chart of our performance year to date of some major indexes. Again, up at the top, Dividend Aristocrats having a fantastic year. But down here towards the bottom, these are the ones that we were talking about a whole lot more last year, just in terms of being the top of the market. And I think we're a lot more client dollars are concentrated. We've got the NASDAQ, which is down a decent amount year to date, and the S&P, which is just about flat.
Right.
So seeing some weakness in those names, especially after coming off of 3 years where they've just performed so well, with the exception of the tariff shock and Liberation Day, which was very short-lived, very rapid. Didn't really give this, I guess you could call it a slow burn time for clients to feel a little bit uneasy and think about moving into something else. It wasn't just that rapid shock that we saw with tariffs and expecting things to jump back so quickly. So just as a little bit of context for how we're getting here, we definitely have been getting more interest from our advisors in these buffered products and how we use them day to day, and how our partners use them day to day. So good time to talk about it.
Yeah, absolutely. Well, should we just transition into the research of the week and go through buffers?
Yeah, I think so.
Sounds good. Well, let's You know, I noticed that a lot of advisors have varying different levels of exposure and experience with buffers, and a lot of the exposure has come from the wholesaler selling the buffers anyway. So, should we start by giving an overview of what a buffer is, how it's constructed, and what it looks like?
Yeah, no, I think that's a good place to start.
Yeah, so a buffer typically offered inside of an ETF wrapper to start. And it's a series of options inside the buffer that have essentially a reset date when all the options come due. So what we're actually going to, for the technical folks on the call that are, wondering what's inside the buffer, it's essentially it's a long call. It is then a bought put. And so long call, long put, and then short a call that helps pay for the purchase of the put and caps the upside of the long side of the call. So basically three three options used in combination to structure a particular outcome between one date and another. The dates can vary. So sometimes you'll see 6 months, sometimes you'll see 12 months, 2 years. Those are the typical ranges that you would see with these ETFs. But you'll have a beginning date, let's just say February of 2026, and then a reset date, February 2027. And when they go and purchase the options, you're actually going to get two numbers. You're going to get a cap, the maximum rate of return, the maximum return that you can get between those two dates, and you're going to get a downside protection, a maximum loss. The maximum loss could be 0%, or it could be 6%, 9%, 10%, 15%, whatever they're offering. There's different ranges that these providers will give of these ETFs, but you're going to get that range, and you're going to get an underlying index that it tracks. A lot of times it's commonly the S&P 500, but you could technically have any number of indices underlying that are tracking that are driving the underlying performance. So did I miss anything there on that Nick, or does that give a pretty good overview of what it looks like?
No, I think it's a great introduction, and I think the other place to tie it into, especially depending on where you're coming from, whoever's out there listening, whether you're an advisor or more on the portfolio management side of things. If you're an advisor, you've probably dealt more with structured products in the past, just because that was the more common exposure to this kind of thing. And then as more adoption has picked up, the ETFs have become more popular. So I think there's some neat benefits to going with the ETF approach as opposed to a structured product. Uh, liquidity being one of them. As long as you're
Mhm.
selling close to the maturity date and you can stagger your maturities, then you get the added liquidity as opposed to a structured note where basically you have to wait for it to mature. Otherwise, you're going to take a large hit on whatever the value is. Um, and then the other thing as well would just uh, it would be the maturing of it. So with the structured product, you've got to go out and you've got to get another one if you want to re-up it. But I think really the cool thing, and maybe we'll get into this in a minute, but the cool thing with these structured products is when they mature, quote unquote, if you just hold that position, you just roll into the next period,
Right.
So
It's a
this doesn't
reset
require,
date.
yeah, this doesn't require you to continue laddering it out like you would if you do an individual treasury portfolio, which I think is kind of the natural progression for like what kind of assets or what kind of return are we looking for with this sort of thing. What does this make a good replacement for? With treasury rates, short-term treasury rates in particular, coming in a little bit, clients are looking for a little bit more of return, but also lower risk. This seems to be a decent option for people to look at in terms of replacing that treasury exposure.
Right, because you can define your risk. You define your upside as well, the maximum upside, but you can define the risk as well. And you're right. So let's get into that. Let's get into some application here. So why would, what's the reason why someone would do this versus a structured product or potentially an annuity of some sort? What's the
Yep.
reason? What type of investor is looking for this?
Yeah, I mean, I think tying into what we've been talking about earlier, it's someone who's looking for limited amounts of risk, decent potential for return, but they're not necessarily looking for aggressive, like we're just going to buy levered QQQ and see what
Yeah.
happens.
It's not a stock portfolio because you're capping your upside. Yeah. Yep.
Yep. So someone who wants to limit their risk, but they also want some return left on the table. Potentially treasuries aren't yielding enough for them at this point. They want to have the potential for a little bit more return. But also someone who maybe can't tie up their money for as long as another person who might look at something like an annuity or a structured product that has a little bit longer maturity date. Maybe a
Right.
little bit less predictable needs in terms of cash flows.
Right. Yeah, that's one of the huge benefits of this is these ETFs are trading every day. So now we're going to talk about this in a minute here, but you can have a profit or a loss anytime between those reset dates, but you are liquid. You are liquid, and it could be, sold at any time at any given time.
Yeah.
So there's really no constraints from a liquidity perspective. Now, the constraint is you can have a gain or you could have a loss. You could have a worse than expected outcome between the reset dates. So let's talk through that a little bit, functionally speaking. What's happening when, let's say we buy, on February 1st, we buy the February defined buffer for 1 year with 100% downside protection. And then, we're 3 months into that period and we need liquidity. We need to sell. What are the potential outcomes that we can have in place here?
Yeah, I mean, potentially you're going to not receive the downside protection that you in theory would, or you would if you held it all the way to maturity, quote unquote. So
Right.
potentially you realize a worse outcome. That's really the big, I would say that's the large consideration before you pile into this thing and assume that you're going to be able to get out of it no problems in 3 months. Again, you do have that option. It's just you don't get that
Right.
downside. So,
Not guaranteed. Basically,
yeah.
that define whatever the definition is, the downside and the upside,
Yeah.
they're not guaranteed anywhere between the goalposts, anywhere between whatever the beginning date is and whatever the reset date is, either 6 months, 1 year, 2 years, whatever the time frame is. They're not going to be. It's not guaranteed anytime in the interim because you have options that are trading in the interim, beneath the wrapper of the ETF, you have these options that are trading that are not going to price in that exact scenario until they actually expire and everything resets on
Yeah.
the reset date. So that's something that's really, I think, extremely important for clients to understand, and in practical application for advisors to understand as well when they implement. Because if you're buying, for example, even if you're buying a February buffer, right, for 1 year with 100% downside protection, after the first couple trading days of the month, you're already in a scenario where your outcome definition might not be the same as what you think it's going to be or what you might have told the client is. So you have to be very, very accurate in your trading and accurate in your description to the client. Because if you, for example, needed liquidity and you told them, told the client that there's absolutely 100% downside protection, this is your cap, well, that's not necessarily true 3 months into a 1 year reset period. That could be totally not true.
Yeah.
So there are some tactics though to eliminate, not eliminate, but reduce that risk. So, one of the things that I've seen done quite well, because that's the big benefit, the most, a lot of the clients looking for these things, they're looking to define risk in some form or fashion, right? And they're looking to define the risk, and they value the liquidity over some other products, like you mentioned, the structured notes, like an annuity, like whatever the case may be. They're valuing the essentially daily liquidity. So presumably, if the biggest risk is that that liquidity is there, but there's losses. So one of the things that we've seen implemented quite nicely is basically laddering the buffers between months. So if you're going to put, for example, $100,000, let's say a client deposits $100,000, and they're going to deposit that they want to put that in buffered ETFs, all 100 grand. Well, if they deposited that now, it's the middle of February, we would actually hold on to the cash for a couple weeks. We'd buy a March buffer, an April buffer, a May buffer, and a June buffer, 25% each, 25 grand in each. And then throughout the year, you actually have this staggered set of buffers that are going to have, different caps, different downside protections, and are going to move differently throughout the year so that if you do need liquidity, you kind of have four places to go where you can go grab liquidity, and you, instead of just one place where you're hoping that if we were to dump all 100 grand, for example, in March, where, well, if we come to August of this year and all of a sudden we need liquidity, we're not just relying on how that March buffer has performed. Um, the
Yes.
other thing is the other thing is it diversifies your caps, because the cap rates are going to be different on each ETF. So you could have 1 month where you get a low cap rate, the other where you get a higher cap rate. You kind of diversify that exposure as well. But from my perspective, the most valuable thing is diversifying that liquidity, because you're liquid. Your actual illiquidity, in quotation marks, is that you have a loss and you don't want to sell at a loss. But you diversify that by having a series of buffers across different months.
Yeah, I think that's a great way to approach it. And, you know, another thing too, with that staggering, because this is more of a, I guess you could say it's more on the conservative side of products. In the meantime, you can have that earning, a money market yield, which, while maybe it's not the same cap upside that you'd see with that buffered product, um, maybe not creating too much in terms of opportunity costs,
Right.
there from waiting.
Not as much. Yeah. Not as much at all. Yeah, absolutely. Well, yeah, so some practical application there. Again, it's a little trickier, but there's really it can be really useful with clients. And again, get into a little bit more detail on who uses these, right? What have you seen as the typical, have you seen, like, what are the most popular buffers? What's your experience on, what have you seen thus far in terms of actual application across the clients that we work with?
Yeah, I think we're still early on in terms of this becoming a popular thing with our advisors, at least with the ones that we work with, just as an outsourced trading partner. But for the most part, it's been clients who have maturing treasuries, and the yield on shorter term treasuries has continued to come down over the past year, and we're not getting the 5% or so that we were getting earlier. So they're
Yeah,
looking for another option. And something like, another common thing that people like to bring up would be like CLO ETFs or something like that, which are likely more risky than something like this buffered product. um, you know,
yes.
they do get a similar yield to what we were getting before, and potentially more, but they're also they can be risky depending on which tranche you're buying, that sort of thing. So um, for the most part, it's been discussed as a replacement for those treasury ladders that were short term. Clients parking the money there, not really sure what they're going to do with it. Potentially they need it at some point, but not immediately. We're just looking for a better, safer investment that could potentially offer a higher return than the yield that treasuries are currently offering.
Yeah, absolutely. That's been the most common case that I've seen as well. Don't get me wrong, there are investors that are looking for those wider ranged defined outcomes, like 15% downside with a much higher upside, much higher cap. Those are more like equity portfolios, and the risk is more like an equity portfolio. So you see some of those occurring, and the ETF flows into these buffers might totally contradict this, but what I've seen in terms of actual adoption from investors is exactly what you laid out, Nick, which is these are a lot of the buffered ETFs. The reason that they're looking for that downside protection, they're not looking to get that equity market exposure, right? If they're looking for equity market exposure with, wide downside and upside, they're most of what I've seen, they're just adopting the, adopting an equity portfolio, diversified equity portfolio, or a equity and bond portfolio. But I've seen a lot. The most popular that I've seen is this 100% downside protection buffers, where you can really either use it as a bond replacement, a money market replacement, a treasury ladder replacement, especially as yields have come down in the bond, treasury, money market world. And a lot of times you can pair it with an equity portfolio as the more conservative exposure, but it just gives this defined outcome with a little bit of extra upside for the investor. And again, the expectation is not they're going to get to that cap every year, but that downside protection of, hey, I'm not going to lose any money, at least not, notwithstanding fees, but I'm not going to lose any money. And, I'm not going to lose any money during this period. And that's a really nice feeling for me, especially because if you're transitioning from a treasury portfolio or a money market portfolio where the yields have kind of, I don't want to say completely evaporated yet, but they've gone down significantly over the last, couple of years.
Yeah,
So that's been the most common use case from what I've seen.
definitely. And there was something that you mentioned there that I think is worth noting as well, would be the fees on these products, because they're definitely notable, and worth considering before doing something like this.
Yeah, absolutely. They range, there's a range of fees here, but yeah, these are not passive indexed ETF fees where you're getting, 2 basis points or 5 basis points or even 10 basis points. These are 50 basis points up. 50 basis points would actually be a cheap expense ratio. A lot of the cheaper ones I'm seeing are closer to 70 or 80 basis points, and it goes up from there. So definitely, all of these outcomes, like you said, Nick, it's important. The outcomes, the downside and the upside cap are before fees. So subtract 70, 80 or more basis points from each outcome as the actual net expected result for the client before the advisor charges their fees too. So if you're working with an advisor, then expect that to come down, another 50 to 150 basis points, depending on what the advisor is charging on that. But at the same time, this is an asset where you technically could charge less on. There's very little to do as the advisor from point to point.
Yeah.
Only something to do if you have to, you know, sell, I guess. At the initial outset, you have to buy, and maybe you have to ladder it throughout. But then, if it just resets every year, it just resets every year. There's nothing else you need to do, like a structured note or a bond ladder, where you have to keep rolling the rungs of the ladder. Not the case here. If you buy a ladder over, a year or whatever period with a client, and you're just holding it there, you're just going to reset every year. There's nothing else you need to do. You're just going to get that, downside protection, and whatever the cap is, it's just going to reset and you have your cap again, and nothing you need to do. The ticker doesn't change, the symbol, the QSIP doesn't change. There's no rebuying, nothing really goes on. So if you were going to structure this as a permanent part of somebody's portfolio, it's not the most inefficient thing. It's actually quite efficient, to just kind of set it and forget it over, a period of years.
Yeah, I think that's a really interesting thing to note, because just, with treasuries, I know the advisors that I send an email to probably once every week or maybe every other week, asking them what they want to do with those treasuries when they mature. I'm sure they hate that email. So potentially removes that bit of burden from their life. Um,
Yeah,
yeah,
absolutely. It certainly does. So
yeah,
hmm, a lot of interesting points in there. I thought it was well worth covering. I think a lot of the coverage in this space has been from biased sources, right? From our perspective, we don't really care if people use or don't use buffers, right? They're just a tool. They're just a tool in
yeah.
the toolbox, and it's important to understand what they can and can't do.
Well, and let's do something really quick. I'm curious. Part of our prep for this was not necessarily doing this, but right now I just want to go on. Typically, we would use Innovator, right? Um, Innovator
Yeah.
is one of the companies we use.
An innovator did not pay to be part of this podcast.
Yeah, they did not, and we're just gonna run. What I'm curious about is I want to see the cap on. We'll just pick like a random month. I want to see the cap and then I want to look at the expense ratio, and then like we'll subtract an average advisor fee, and I just want to see what the difference between the cap and like a 1-year treasury yield
Yeah,
is right now, just out of curiosity.
let's do it.
Um, let's see here. February buffers.
Yeah, you use February, like February 1st. They would have just reset, and you can look at the initial cap. The downside would be, if you're looking at the 100% downside protection, then the worst case scenario is 0, obviously.
Yep. Okay. So perfect. Yep. ZFEB. It looks
Hmm.
like the cap with that's the 0% downside protection, at least if you purchased it on inception. Looks like the cap is 6.37%.
Okay.
6.37%. Okay, so we're starting with 6.37%. Now let's see if we can find the expense ratio is 0.79%. So I'm just going to take a note here. 6.37% and then minus 0.79%. Now that cap does exclude the, yeah, okay. So yep, we're right to subtract that. And then what do you think for an average advisory fee? Like 1%?
100 basis points. Yeah, I would say
Yeah.
so.
All right. So let's see here. To prevent looking like a fool, I'll do this precisely. Okay, so minus fees, that cap leaves you with a 4.58% return. So that takes out the expense ratio of the fund. That also takes out your typical advisor fee, which, you know, maybe a little bit less, maybe a little bit more.
Right.
Now, if we go to
We,
Schwab,
yeah, what's a 1-year treasury?
it is not 4.58%. I can tell you that much. 1-year treasury is 3.538% right
All right. So you got about a 1% premium if the S&P, if
now.
you are able to, if the
Yeah.
S&P returns more than the initial cap of 6.7 or whatever it was.
Yep. Yep. I think that's the big thing now that the treasury is, for the lack of a better term, guaranteed.
Right. So you are taking a little bit of a gamble. You have more variability than a treasury or money, I guess money market is variable interest anyway. So let's just use the treasury. You do have a little bit more upside in the sense that if the S&P returns on average 8 to 10% per
Uh,
year, in most years a you should have that 1% premium like we're calculating now. But you're gonna have some years where your return's gonna be 0.
yeah. Or potentially less, really, if you factor out
Less if you
fees.
factor in fees. Yep,
Yeah. Yeah.
exactly. But you do
So,
have that's where that similar, like comparing it to a treasury money market bond portfolio, is that's where we're coming up with that, because in real the risk and return profiles are more similar to that than equities, which even though equity index is the underlying metric used.
yeah. I mean, they're really not the same, but we get a number of clients. I've had this happen a lot. They'll call me and they'll ask, hey, what should I do with this treasury that matured? I see that I can't get that in another treasury, or, you know, I can't get 5% in another treasury. But we look at CDs. CDs don't yield much more. How do I create more return without taking risk? And basically, the answer is you're going to have to take some risk.
Right.
Unfortunately, those days are over of getting 5% for essentially no risk. They're gone. But this is one of those things that it does mitigate your risk, and it very well could be a decent option for someone.
Yeah, yeah, absolutely. And like we've said, we've been talking primarily about these 100% downside buffers, but
Yep.
there are other ones as well that give you different risk profiles. The key is in all of them, you're defining the up cap and the downside risk, which again, for a lot of clients, for certain clients, in certain in a lot of cases, that's a comforting feeling to know what the upside, what the downside is. That's the most comforting thing. And
Yeah.
then they're willing to accept, okay, my maximum is whatever. And yeah, it's not a like I said, it's not something that we are per se recommending. It's just a tool in the toolbox that we think people should be aware of.
Yeah, definitely, and readily accessible.
Yes.
toolbox as well.
Yep, absolutely. Very readily accessible, easy to, once you understand the mechanics, very easy to, pretty easy to implement and to roll over each year. So
Yep.
awesome. Well, hopefully somebody found that interesting.
Yep. That's the motto with all of these. Hopefully someone found that interesting.
Yep, absolutely. Well, I've got one trivia question. I didn't do so much trivia prep for this one as I maybe should have, but I have
Perfect.
one trivia question if you want to hear it.
Yeah, let's do it. I've got two. One of them's a throwaway. It's more of just a joke, but
Okay, sounds good. Well, I'll go first here. Over the last 20 years, what country's equity market delivered the highest total return in US dollar terms among major global markets?
20 years,
20 years.
2006. China,
I was getting what I saw was India.
India. Okay,
India.
that I can see that.
Yep.
I can see that. That makes sense. I like it. Do you have the number?
Yep.
What their total
I don't
return
have
was?
I don't have the number in front of me anymore, the updated
Yeah,
one, but here's
that's
India.
that's kind of. I mean, that makes sense. I high growth economy and everything like that. At least at this point, like a pretty fluctuating currency, at least relative to the U.S. dollar. So
Yeah,
that's interesting.
kind of makes sense.
Interesting. Okay. Well, that was a good one. I wouldn't have guessed India.
I don't
All
know that I
right.
would have either.
Yeah, that somewhat surprising. All right, let's see here. This one's more, we're just gonna go on the history of ETFs. What was the date, or we'll just go, in what year was the first ETF launched? And bonus points if you can give me the exchange.
What year was the first ETF launched? I'm gonna guess 1979.
Not 1979. A little bit later.
When
A little
was
bit
89?
close. You're very close.
90.
90. 1990.
Okay.
You want to take a crack at the exchange?
Of the NASDAQ?
No, no, it wasn't the Nasdaq. It was actually abroad. Saying the Toronto Stock Exchange.
Really? Okay.
Yep,
Interesting.
March 9th of 1990. Shortly thereafter, the SPY, the classic SPY, was launched in 1993.
Okay. Gotcha. That makes sense. Largest should be the largest ETF in the world still, right?
Don't know off the top of my head, but probably.
Yeah, I think so. Huh,
Yeah.
interesting.
Yep. So relatively recent, all things considered. All right. Are you ready for the joke one?
Yes, I am. Let's hear it.
All right. In what era was the vest made a formal part of a financial analyst's uniform?
In what era? Like, should I give you I'm
You
gonna
can give
guess
me
the
like a
early
decade.
2000s.
I don't really
Yeah,
care.
the
All I'm saying is
early
JP Morgan
2000s.
wasn't wearing a Patagonia vest to work.
That's true. I'm gonna guess early 2000s. I feel like that was when we started to get more casual.
Yeah, pretty much. Around 2008, basically.
Yeah.
They were saying it was a way of flexing your wealth without buying a full-on suit. So the Patagonia vest became the uniform.
That's funny. That is a funny one.
Yeah,
Uh,
gotta keep
I
it
like it.
interesting.
Gotta keep it interesting. Awesome. Well, a good episode this week. Hopefully, so like I said, hopefully some people found it interesting. I thought it was useful to cover some buffers and get some interesting trivia as well.
Oh yeah. Well, I think that does it for this week.
I think it does too. Thanks, Nick.
Thanks everyone.
Bye.
Bye.